the government needs to understand the dire situation the hotel industry is in. We were hoping for a strong recovery in the summer, but regrettably it didn't pan out. And at this time, the fall season, usually we would enjoy pretty good corporate and meetings and convention business. But obviously, all those segments have been compromised, and winter is usually slow. So as we look at the next 6 months, according to an American Hotel Lodging Association survey, 3/4 of the hotels are planning further layoff. Now, mind you, we already lost almost 4 million jobs. That's 4 times more than national average. And 2/3 of hotels say they only have reserves to last maybe 6 more months. And half the hotels have already said that they are likely to default on their loans. So at this time, we urgently need the government to help us. The Main Street Lending Program is supposed to provide much needed relief for our industry. But regrettably, look at the $600 billion they approved for lending. Only $2.5 billion have been provided. So that speaks to the inadequacy of the guidelines that have been provided. Specifically, I think it's really important to look at how the banks are being instructed to lend. The EBITDA-based tests are just not relevant at this point because obviously the industry has been decimated. An asset-based test or perhaps using the EBITDA from previous years would be more appropriate.
Well, I'm curious to explore that a little bit further because as it's structured right now, the Main Street Lending Program has a $5 billion cap on revenue, a 15,000 cap on employees. It defers principal payments for 2 years and it defers interest payments for 1 year. The Fed and the Treasury would argue that that is structured to allow small and medium-sized businesses like hotel franchisees to access this money. But what is it specifically that is keeping companies like Best Western from qualifying for these loans?
Yeah, it's really for Best Western hotels. And if you look at the lending guidelines, there are debt ratio coverage requirements, and they're all based on the current EBITDA performance. And the Fed is asking banks to underwrite the loans, and banks are not in the business to lend money to failing businesses. And in addition, the banks are on the hook for 5% of the loans. So when they look at the performance of our current hotels, they are hesitant to lend, and that's the problem.
The furloughs and the layoffs overall, industry-wide, or maybe even just for Best Western, what's happened to break-even occupancy rates? What's happened to break-even room rates if in fact operating leverage is at least getting a little better?
Yeah, it's a policy to think about the occupancy level on its own. And I know you talked about average rate, which is a really good thing to look at, because the reality is for our segment, usually if you run 45, 50% occupancy, you have pretty good break-even level. But regrettably, the average rate is down by almost 20%. So although we are currently, because of the strong, summer is traditionally the busiest time of the year, we're running about 50, 55% occupancy right now. But because the average rate is down so much, we're continuing to lose money. Right now, we're up by 40-some%. Towards the end of the year, we expect the year to be down by about 50%, which is a very, very high number.
It's the unfortunate reality for so many industries right now. David, we appreciate you bringing the story of the hotel industry to us today. David Kong is the CEO of Best Western International.
Shepard Smith here. Thanks for watching CNBC on YouTube.